Oh man, we are hours away from a critical FOMC meeting Bitcoin, just cooling off slightly after a powerful two-day rally here. What are we expecting from Jerome Powell? Will he rug markets, or will he give us reason to continue our recent rally here on Bitcoin, sitting at 27.1 markets, fully pricing in this notion that we will get a pause? Now remember, that is a double-edged sword. If we do not get the pause that the market is pretty much guaranteed, right? They've not priced in any pain of a pause. We could be getting an almighty rug pull. Now the good news is, the very good news is that nobody is expecting this pause, right? Whether you look at BNP Paribas, BMO, Barclays, Bloomberg, Goldman Sachs, JP Morgan, Morgan Stanley, all of them are pricing in the fact that we will not get a rate hike today. But what if there is that slight chance, right? What if we do actually manage to get rug pulled by Jerome Powell? Now, I personally don't think we're going to get that, but I think the detail is going to be the devil today. It's going to come down to the press conference, how Jerome Powell speaks, but more importantly, which many crypto channels just don't want to talk about, partly because they don't understand it. It is the summary of economic projections. Yes, we get an SEP file today, which gives us the real detail, right? That any 2-year-old be like, oh, rate hike, no rate hike. No, it's the detail that's going to move this market. So when you see the markets moving, when we live stream later on today at 7 p.m. when the decision comes out, one, it's going to be the pause or no pause, right? We expect him to pause, fine. But you've got to quickly open up this PDF, which we're going to do today together, and we're going to understand what is the detail. And the main thing I want you guys focused on is this figure here. This 5.6 figure is what they estimated would be the Fed funds rate by the end of 2023. Now, currently, you guys know, we are sitting at 5.25 to 5.5. So they priced in just about above or out of the median was that we'd have one more slight hike. So between where we are now and one more hike. So we need to see, does this change? Does this figure change? Now, remember, it was revised up in March. March was 5.1. In June, they revised it up to 5.6. Will they change this? This is going to give us the clue that they want to do more rate hikes before the end of 2023. So we will pay close attention to that. We'll also look at the change in GDP to see if they think the economy is going to be growing a lot stronger than they previously thought. I think that they may revise that up slightly, maybe to 1.2, 1.3, that kind of range. Unemployment, maybe they're going to revise that up slightly as well. We'll see where that comes from. Remember, that was revised down from 4.5 down to 4.1. Maybe they'll notch that up slightly, but those are less of a concern. The main concern, really, we know what we're expecting from inflation. It has been cooling down, just not as fast, really, as Jerome Powell wants it. But it's going to be this bit. It's going to be the agreement on the dot plot, okay? Remember, this is the dot plot we saw in June, where Fed officials, each of them, vote on where they see interest rates by the end of 2023, 2024, 2025, and longer run. Let's focus on this. At the last dot plot, the majority of officials here, if you count the dots here, sat in between the range of 5.5 and 5.75, okay? So if you wanted to put the Fed funds rate to 5.5 to 5.75, they're basically saying one more rate hike and we're done, okay? And if you look at what markets are saying, you got the markets fully expecting a pause today. 100% of the markets are priced in a pause today. Then 70% of the market are expecting us to stay paused at the next meeting in November, and the vast majority are expecting us to stay paused by December. So currently how we're set, the markets are not pricing in another pause. They're not pricing in what we were told in June, that the majority of Fed officials want at least one more rate hike, with the three members here wanting more than one, right? Some of them wanting two and some of them wanting 3. So we're going to need to see the updated version of this. We'll look at these dots to see, do these shift down? Do the majority of them come down into where we are now, which is 5.25 to 5.5? That's its line here. Or do they stay where they're at? Or do they go up, right? If they go up, that means we're getting more than one rate hike. Remember, if we get a pause today, that only leaves the November meeting and the December meeting, which would mean that would be a 25 basis points and another 25 basis points. Or another pause in November and a 50 basis points in December, right? Either way, we need to see what they're pricing in and what the disagreement looks like between them. Then we need to focus on something else important, which can move the markets. And again, guys, if you appreciate this kind of detail in this crypto space, which won't get too many views because I'm not telling you this is the 1000x altcoin, this is the gem, Bitcoin to 100,000. I need your support in this bear market. I need you to like, hit the comment button and subscribe. It really helps the algorithm and we can get this content out there, right? If you're fed up with the Moon Boys, then you guys have to take action because otherwise I'll make content like this. You guys don't care about it. So I'll just keep the data to myself, right? I'll just trade on it my own. But if you guys want this type of data, you've got to support because those Moon Boy channels, they naturally get support because they're showing sensationalism, right? But we're not doing that here. If you appreciate this type of content, you've got to support. So when we then see this, I want you to focus on the next bit, and that is where do they think we're going to end up by the end of 2024? So look at the detail. In the June report, they said here that we would end the year at 5.6% median on the Fed funds rate. Of course, you can't be at 5.6 exactly. It's that range, right? 5.5 to 5.75. So then they're saying, okay, by the end of next year, we expect to be at 4.6 in December 2024. In other words, that is a full percentage cut next year. So that could compromise of like 425 base point cuts next year. That's what they told us in the June SEP. So we want to look at this number to see if this changes. Do they change their stance on how long they want to keep rates higher for longer, or if they're going to cut quicker? So if this gets revised up to, let's say, 5, that means they want to cut far slower next year. They want to keep rates higher for longer. If they keep this at 5.5 or something like that, then they're saying we're not going to do any cuts next year. We're just going to keep it at 5.5 range all the way until the end of next year, at least no cuts next year. So markets will be looking at this to give them some clues, some excitement of whether we can get a cut and how many cuts we get next year, right? Because that's where the conversation is going to switch to. The market pretty much think they know where we're heading for the rest of this year, which is the last 2 meetings after today, but they also want guidance for next year. So we'll look at the dot plot to see where do we see it. Remember, this was quite skewed last time. Remember, the further you try to predict out, the more kind of varying opinions you get from the FOMC chairs. From the FOMC participants. But what we want to see is where do the majority sit, right? Last time you could see there was a clear majority here sitting at that 4.25 to the 4.5 range. So they did see about a full percentage point cut on average here as the median. So we want to see, does that remain the same? Will that go higher? In which case we're in for a bit more pain, remember, because it means rates will stay higher for longer, or they bring it down even more. I don't think that's going to be the case. Now, the other thing I want to mention is something really important, which is why will Jerome Powell punt the opportunity to let the market tighten on his behalf? And this is a very interesting point which you guys have to be aware about. It's called jawboning. Jerome Powell has an instrument he can use called rate hikes, and he can use that to tighten financial conditions, right, through a lag measure. Whenever you increase interest rates, there is a lag measure. It takes time before that circulates around the economy and leads to inflation cooling down. Alternatively, he can use his words, and he's done this really effectively pretty much over the last 18 months when he's been at these press conferences. It's known as jawboning. It's when he speaks hawkishly, he speaks aggressively, hoping that the market will tighten financial conditions. Now, clearly, Jerome Powell's done a great job, because if you head on over to the dollar index and we look at the weekly chart, Jerome Powell be thrilled, right? When you look here at July, remember the last meeting was in the last summary of economic projections were in June. Since then, look at the rally that the dollar index has been on, an insane rally. And remember, the dollar index rallies when risk rotates off. So Jerome Powell will be happy about this. Risk rotating off brings inflation down, tells the market to chill out, which is what he wants. He wants the market to cool down. So with that being said, I expect him to pause today. I expect him to come out and be hawkish. I think he could rug the markets with his words, coming out sternly and saying, guys, the work is not done. There is not enough progress. We need to do more, right? The job is not over till it's over. I don't think he's going to come out and do a victory lap, because if he does, dollar index could tumble, Bitcoin could run, risk on assets could run. I don't think he wants to do that. I think he wants to make sure that inflation does not rear its head again and he gets the job done while the iron is hot. I know that may not be fun for us. I know it's been a long 18 months. I know it's been one of the steepest rate hike cycles we've ever had. But if you've been through it and you've accumulated and you've dollar cost average, you've built your conviction, you have absolutely smashed it. Because one thing I know for sure, whether you're doing this through crypto or real estate or stocks, you managing to go through this boom and bust cycle of interest rates, you've done an amazing job seeing that. And if you've done that, that's going to stand you well for future cycles as well. So it's definitely a skill you have learned. Finally, Jerome Powell already, remember, has priced under his his toolkit, he already has this figure, right? The 5.6. So he told us in June, we're going to go to 5.6. We're at 5.25 to 5.5. So he's got that one rate cut already under his belt, right? He's got it. He can keep it there and choose to use it. So the question is going to be, and most economic participants will believe, why will he give that up, right? Why would he change this, bring this down to, 5.3 to the range we're currently at? For no reason. Why does he not just keep it there, just to keep markets fearful, to keep market conditions tight, instead of giving it up? If he doesn't use it, he can then just not use it in the next meeting in November, December, and the markets could rally off of that. So we've got a critical FOMC meeting, guys. I'm going to leave the link in the description for you guys to set the reminder for the live stream later on today. It's going to be a banger, it's going to be important, and Jerome Powell could rug markets. I'm not expecting that crazy rate hike. If he does do it, guys, it's going to be a hell of a pain. For us to get any green in the market, Jerome Powell's going to have to come out soft. But I don't think that's going to be the case. So for me, looking for low price points, looking for DCA entries, and looking to see where will we call off here on Bitcoin. Hopefully you guys enjoyed this summary. If you appreciate this type of content, smash up the likes. Don't forget to subscribe. Go watch this video here, and I'll see you in the next one.